Thank you, Charlie. Good morning, everyone. Welcome to the August meeting of Mountain Community Capital Fund. Appreciate everybody being here. It looks like we have a quorum today. Is that correct, Rachel?
That's correct.
Great. Well, let's go around and do a roll call. I'll go by my list here. First one is a phone number, 855. That might be you, Kelly.
That is our public input.
Okay.
Just for the folks, if they would like to call in, they can listen that way.
Okay. I'll start with you, Charlie.
I'm Charlie Savage. I'm a member of the City of Asheville staff, and I am not a voting member.
Dee Williams.
Good morning, everyone. My name is Dee Williams. I'm a county appointee, and I am a voting member.
EB.
E.B. Otterstall, county staff, non-voting.
John Appleby.
Hey, it's John Appleby. I'm a voting member appointed by the City of Asheville.
Kelly Foster.
Kelly Foster, Mountain BizWorks, non-voting member.
Next one up is KONC. Anybody know who that is? How about Lydia?
Good morning, Lydia Turgeon, Carolina Small Business Development Fund, non-voting member.
And
Michael.
just, Karen ONC, that's me, Karen Romansky.
Oh, there you go.
Self-help, but I'm a non-voting member.
Hi, Karen. Michael.
Michael Lane, Mountain BizWorks, non-voting member.
Nikki.
Good morning, Nikki Reed, City of Asheville employee, and I'm a voting member.
Rachel Sawyer.
Morning, everybody. Rachel Sawyer here, Buncombe County staff, voting member and secretary.
Rachel Taylor.
Good morning, Rachel Taylor, City of Asheville staff, and I am not a member.
Tara Brown.
Good morning, Tara Brown, Self-Help Credit Union, and I am not a voting member.
And last but certainly not least, here is Yaslin.
So Yaslin Gonzalez, Mountain BizWorks, non-voting member.
Welcome, everyone. I'm Carl Alguire. I'm vice chair, a city appointee and voting member. Tim Love is on the beach with his family this week, so we'll miss him. And we have a fairly short agenda this week. And we will open with staff updates from Rachel Taylor.
I think first let's do the approval of the minutes.
Oh, yes, absolutely. My bad. All right. Yes. Has everyone had a chance to look at the meeting minutes from the 12th?
I'm looking at them. I'm looking at them now, and I think that I made a mistake in the attendee record. John, were you present at that meeting?
No.
I was at the beach, unfortunately.
Okay, got it. I was writing your name down today and thinking, uh-oh, did I forget to write you down? Okay, good.
Also, and today the agenda says we start at 10, so we'll want to adjust that going forward. So any other comment on the minutes? Additions, deletions, motion to approve?
I'll make a motion to approve. Nikki Reed.
Second.
I'll second.
I'll second.
All in favor, raise your hand or click your hand. Thank you. All right, Rachel.
All right, thanks. Yes, so we've got a couple of updates. First, for the governing documents, the City of Asheville has provided edits on the governing documents. We're working with the county now to review those edits and combine those copies. So we will have those documents to review soon. We will come to the table with you all to review those edits. The general approach is that we are reflecting our current practices and then just kind of outlining the progress of this fund so far. So that's where we're at. We'll also come to you with edits regarding the rules of procedure and those other exhibits, the underwriting guidelines. So we will update you all kind of with a presentation and walk you through that. But in general, I wanted to let everyone know that there aren't any major changes. It's reflecting what we're currently doing, just kind of working on making that a little bit more nimble. We're also going to add, we had talked about this a couple months ago, we'll add a link to the MCCF page on the City of Asheville's website, that kind of formal boards and commissions page with a link to all the relevant documents. And I've got the folder here. We just don't have the link live yet, but it basically will contain a link to the previously approved guiding documents, as well as lender reports and loan and claim requests. I've only gone back so far as the last fiscal year, so that can just help us to kind of stay on track and be organized with some of our previous documents.
Will that be located where we currently sit, or you're saying we're adding a page? We're moving up in the
I will.
city.
I think it might be easiest if I show my screen, and I will give me 1 second to navigate to the page. So we are working with our city clerk's office to have at least a little bit more kind of continuity between the boards and commission pages. And so basically here, if you go to government and then you navigate down to boards and commissions, this is our Mountain Community Capital Fund operating committee page. And of course, it's got the link to the agenda, documents, minutes. Up here in the description portion, here's a link to current board members. There will also be a link to this public documents folder. And most of the documents, you know, are available through these document links, but obviously that's a bit harder to navigate. So this is a way where both you all as members or as staff liaisons and the public can kind of orient to our documents a little bit quicker and easier.
Cool. That's great. Thank you. Any questions for Rachel? Okay, the lender update. Yaslin?
Hello. Yes, I will share my screen. A second.
And while she's doing that, I will say it. I'm sorry you missed it last month, John. You know, I think last month we made such progress as a group to clarify sort of the direction that we're trying to head and the work that's underway, the improvement of reporting, better understanding of the process when loans are made or going into default. And, you know, the progress that we've made on knowledge of these loans is really significant over the course of the last 18 months. So good work by Mountain BizWorks and everyone that attended. It was a really good meeting.
Thank you, Carl. All right. So I will hit share. Okay. So got the monthly report here, and this is as of 6:30.
Can you blow that up a little bit?
Mm-hmm.
Thank you.
So this is as of 6:30. We did not have any loans in June. If you recall, there were some loans that were approved at the last meeting. Of course, that was for July. And we'll see some additional at the next in the next report. So they usually there's usually a little bit of a some time between the approval and the closing. So therefore, no loans in June. So we've got 68 loans as of then. New total dollars lent 2.5. New dollars lent was 2.2. The original guarantee used was 2.1. Outstanding loan count, we've got 48 that are active in the portfolio. We've got 1.6 that is outstanding. As far as the outstanding guarantee, we got 1.4. So we're currently using 50% of the guarantee funds. So that's one of our triggers, of course. And we're at 50.27 out of 100%. Total delinquent loans has remained the same, which is 6. The loan amount has been 183,416. Demographics haven't changed either from last month. So 5 of those loans are Black or African American. 1 is Latino, which is the percentage of dollars outstanding is comes out to 11%, cannot exceed the 20%. So we are staying on track there with that trigger point as well. The total guarantee allocated to the delinquent loans is 155,904. And you can see the breakdown here of the delinquency. So 31 to 60 days. 2 of those loans have been delinquent, 61 to 90, just 1, and then greater than 90 days is 3 of those loans. Charge-offs have remained the same. We have not charged an additional loan off this month yet. We're still at 1.7. So trigger there is 5%. We're still in good standing. No loan payoffs this month. Payoffs to date, 13. Total of 430,561. 6 guarantees have been approved, which is 116,000. The demographics of those claims are down here. So 5 African American, 1 other. And then demographics as far as the breakdown of the loans. So 44 loans are to Black-owned businesses, which is 65% of the fund itself of the portfolio. 13 have been to Hispanic or Latino, which is 19% of the portfolio. And 32 of those loans were to women-owned businesses. 17 loans were made to startups as of origination. Loans to existing businesses have been 51. And loans currently in startup phase are 8 of those, and we're at 11%. So still in good standing there as far as that trigger goes. And then 248 jobs have been created there. So with that, I will open it up for questions.
Hey, Yazin, I do have some questions, but not on the data that you just went through on the other spreadsheet. So if maybe Dee has a question on this spreadsheet, then maybe she can go ahead, and then I'll ask some questions on the other spreadsheet.
Dee, go ahead.
Thank you. And I guess the question is, we've got 3 that looks like they're 90 days and over. Specifically, what is a timeline for writing the loans off? And if they're over 90 days, specifically, how much past 90 days are they? I guess that's what confuses me. Who determines, or what metric is used to determine when the period of write-off shall occur? Or is it something that's based on maybe not so much data or an exactitude, but if this entity or person is non-responsive? I guess I'm just looking at it. It looks like there's trending going on. And I guess that is what disturbs me somewhat, is that there seems to be this trend, not unless these loans that are in default or delinquent are being carried over from last month's meeting, and then some of them for an extenuated period of time. Is there information about that? Thank you.
Thanks, Dee. Kelly, can you speak to that?
Yeah, sure. I think that's a good question. But I think it's good to remind everyone, if you have an account that hits, a delinquent phase, if it's over 90, 120, wherever it hits, we as an organization, we still work those accounts, and our goal is to work with the clients to be able to get them back on track. We do not charge something off until we've exhausted all resources to where we do not think we're going to be able to collect any more on it. The three that are the most delinquent on the accounts, we have been in touch with those clients, and so we still have belief that we think that we'll be able to get payments from them. So we don't want to just give up and charge them off. We want to be really fair, work with the clients, try to find out exactly what the obstacles are that's causing them to not be able to pay. And in the three that's most, well, all of them we have, but the three that's most delinquent, we do know what's going on with them, and we are trying to work something out with them. And so the goal there is, if we can get them back on some type of regular repayment schedule, then slowly you can work them off of the delinquency and get them back into current standing.
Kelly, is the problem cash flow? Is that what it is? Because it looks like, from my experience, it looks like that is what that is. And is there, I guess it continues to, if these are some of the same ones, it continues to plague. Is there a plan to disrupt the lack of cash flow? Or I guess I'm just looking for an answer. I'm a solutions oriented person rather than just, so yes, please.
Yeah, no, that's a very fair question. And that's what we do, is we try to find out what the obstacle is that is impeding their cash flow. Because obviously if they're not paying, they've got a cash flow issue. I can say, I can't give too many details, but I do know on two of the accounts that are past due, they had a large contract that's not been paid, it's been delayed. And so they're trying to get that one paid. And so, when something like that comes up, then we look at, okay, if your cash flow is depending on one major contract and that's going to derail your business, how do we need to support you? How do we need to, diversify that a little bit? And so, yeah, they are cash flows. Some of them are tied to contracts.
Is there a way to assign that contract? I know that in my past, when there was a large contract, one of the things that I wanted to do was to make sure to get paid, that there was a joint agreement, that a co-payment agreement, that when they got a draw, I would get a portion of funding. Is there anything in place like that?
Not on these, there's not. Well, no, let me back up, correct myself. One of the loans that are past due, it was tied to that contract, to where once they got paid with that, they would pay the majority of the loan off. And so that is correct. We did have that on one of those. The other one was on various contracts. The larger one, didn't come through for that one. So if it's a large contract and it's heavily tied to the large part of the revenue, then we do everything we can do to tie it to that. It is difficult to actually make sure that happens, just historically, because it's hard to place a lien on those. So sometimes even if you have that agreement and they're signing an agreement with you, it's hard to make sure that those funds actually come to us. But yeah, to answer your question, we do try to do that.
Well, there is such a thing as assignment of a receivable. Other outside entities do it, but I understand your take on that. And my last question, and I'll suspend, is that how many of these delinquencies are the same ones that we saw? Obviously, it seems like they all are from the last time we had a report. So these are the same ones. And I do see that there's one Hispanic business. I might have missed something last time, but I didn't see a Hispanic business on the spreadsheet. Is that true? Last time?
I would have to go back and look at the numbers from last time. But to answer your question, as far as the ones that are delinquent that are on the report now, they are the same ones that have been on the report the last couple of months. So we haven't had one that was past due that fell off, and then we've not had a new one that basically defaulted and took that one's place. So you know, that's a good thing that it's the same ones, but you know, it's a bad thing we've not been able to get them off yet, but I'm hoping we can do that.
Dee, you're correct that these same 6 loans were listed as 6 Black or African American borrowers when we saw this month with this report last month. So there's been a change to that data. I would ask that Mountain BizWorks let us know if it was an error that was previously corrected, or is it an error today?
Yaslin, can you speak to that?
Yeah, I will have to go back and double check. As far as I know, that had been correct. So I'll have to, there was an update in the loans there, and we had a Latino loan that became delinquent. I will have to go back and double check that.
Yeah, because the count's the same.
Yeah, I had to be careful because I've got the account names in front of me over here. Looking at them now, there is one in the, I think it's 31 to 60. But I would have to go back and look at that from last month. I don't have those numbers in front of me.
Is it on the other tab of this public report?
It should be.
Yeah, it's going to take me a minute to look at it because I don't have the names there. It should be in the over 30.
I can capture this as a next step for next meeting.
Yeah,
or we can come back to it. So,
Yeah,
John,
sorry,
go ahead.
it is in the over 30 one there on the column J there, Latino. So that is correct.
So I have multiple questions on that spreadsheet you've got up, Kelly. So so this data is as of 6:30. So we're a month on, and I know you've not updated it because we've had this conversation before. But of the 8 loans that you highlighted as basically less than 30 days overdue, are any of those 8 loans caught up? Or are those 8 still now 30 plus days overdue? Do you know? So there's the 6 loans that have been overdue a long time, and then there's now 8 showing up as kind of like potentially problematic.
Yeah, if the question is if you're asking if those 8 loans flipped into the over 30 category,
yes,
I'd have to get back because we're on the 2nd of August and our cutoff is the 31st. I mean, I could look at the accounts and have a good idea what the names of it, but as far as like officially reporting it, I'm going to have to go back and look through the reports because we just closed the month out on the 31st.
No, I've hammered this point endlessly. It's just that, you know, we're looking at this data that's basically 30 days old. And so a lot potentially could be problematic over that month. These 8 loans so we could be staring at 14 loans who are basically past due. So it feels problematic that we don't know that in these meetings. So I don't know a way to solve that other than maybe, you know, you have the information at your fingertips in these meetings. I don't know. I got a couple of loans where I feel like the data's wrong, unless I messed up my data sort, which I'm so out of touch with using Excel these days that could be possible. But loan number 26170104, if you could find that loan, 26170104. You might have to do a fine.
Could you give me the search the loan number again?
26170104.
You blow that up, Yaslin.
Like it shows it, so you see it says past due. I can barely read my screen, but I think that says past due, but there's no highlight for number of days or anything. So what is going on with that one? So it says past due, but there's no highlight, so it says 0. So one of the two things can't be right.
Y'all can scroll back over to the number of days there.
Well, it says 0 days, but it says past due, so something is not right there, presumably.
It looks like that one was paid off. It's got 0 balance there. It was probably paid off, and it may have been one of the claims. I'd have to look at the the number to the name on it. See, scroll over and see if that was a claim.
Well, obviously, if it's wrong, it's going to be reflected on the summary sheet that Yaslin just went through. I
Well,
have another one too. So can you find the next one?
Just to clarify though, it says the active guarantee on that is 0. So that means it's not in the program anymore. So if it's not in the program, it would not show on the front sheet as past due.
No, I get that, but presumably it could, if it's been repaid, then that's good for us because it reflects we've now got 3 loans that have been fully repaid instead of 2. Because right now it doesn't look like we're getting very far because we've only had 2 loans repaid in full. The rest have either been refinanced or, gone, we've had to pay out claims. So if we can claim the 3rd one, that looks better. So just knowing the status would be helpful. I got another one. So can you find this one? 2639-0101.
Hmm.
Of course, I could have written it down wrong. 2639-0101.
About line 28.
I've got it.
Okay.
So that one is showing as current, but 30 days. So it's highlighted as a problem, but it's showing current. So again, one of those 2 things has got to be wrong.
I missed what you said on how many days it's showing as past due.
Well, it's highlighted as in pink, so I can't read my screen. I'm sorry, but so it's highlighted in pink, so there's a problem, but then it says it's current. So one of those 2 things is wrong.
Thanks for the clarification.
I don't have access to our system right now because the laptop is down. But what may have happened on this one, if that one was 30 plus and it's showing current now, and this information is pulled over from our database, that's probably why. And I would have to verify this. I think this is what's happened. That one could have paid current and come off, and then the other one, it was flagged as Latina maybe in there, because it says past due as of 6/24 in the loan payment status. It may be pulling as what the loan payment is right now as current, but I've got to verify that. I don't want to say for sure right now on this call, but I want to verify that before I answer that question.
Well, I know I sound like a broken record, but I don't have any confidence in the data that we look at when I find such. I mean, I just look at it for like 10 minutes and find obvious mistakes. So
well, but that one, just to clarify, if that means that it's current, then if it's current now, then that would be correct. And the other one that you were asking, I looked that one up, and that one, it was past due. The account was past due, but they paid us off. And so it's going to show what the status was as the date it was paid off. But that past due is not going to show on the report because it's not part of the portfolio now. It's got a 0 balance in there. So that would be correct on that spreadsheet.
which one? The prior one?
Yeah, the one you had asked about first, that had the 0 balance there. It was past due. It was in a past due status, and the client actually paid us off. And so when they pay us off, it's going to show as a 0 balance on the spreadsheet there. But it'll show whatever the past due, whatever it was as of when it paid off. So it will say that it was past due on there.
So you're saying it could be past due and current?
No. If it's got a 0 balance and it had past due, that means that the account was past due, and then the client paid the account off, and the status at that point in time when they paid it off was past due at that point in time. But if you look at the 0 balance in the actual guarantee balances there, it shows 0, and it's showing 0 because there's no funds allocated for the guarantee, because it's no longer enrolled in the program to be anything paid on it, and that's why it does not show on the front sheet.
Is there a status, a loan payment status for repaid. I see one that says repaid early.
There, I think there were one.
There should be.
Actually, I think what they did is when I talked to Matt, when we set it up, we had the conversation, do we want to show it as repaid or released, because you're releasing the guarantee fund for it, that you're not holding that anymore. So if it says release on there, that would either be, yeah, if it says release, that means it's paid off. If it says claim paid and shows a zero balance, that means that we submitted it and it's showing a zero balance because the claim was paid. So release means it was paid off.
I guess, Kelly,
Just to clarify, John, right, sorry to interrupt, but just to clarify, so some of this, when Kelly, now I understand, I kind of went through the data and looked. So we had a loan that paid off, which dropped off, and that loan was Black or African American. Now we had the Latino loan that you see on there that came on our on the report here over the last since the last report was presented. So that loan that you're asking about is the loan that's been showing that, which is a Latino loan.
So we did have a change. It was presented that there was no change, but we did have a change.
Yeah, we had a change in the 30. See, when I'm looking at these, I only have account numbers because we can't make those public. So when I'm looking at that, making that comment, I've got the same numbers. I've got the other spreadsheet up here that's got the accounts on there, and that's how I picked up when I was looking at it in real time here, is that there was a change in the one. We had one that paid, that dropped off, but then we did have one that's actually in the 31 days past due, or the 31 plus days past due. Excuse me, 30 days past due.
All right, John, any other questions?
Yeah, I've got a few. I got a couple of things. So there's quite a lot of loans in the spreadsheet that have basically been refinanced. So there's a line that says refinance. Is there a way to tie? Is there a way to tie the loan that's been refinanced to the current loan? So when you look in the spreadsheet, you can see the refinance loan is connected to the new loan. Because right now you can't tell. You just see the loan's been refinanced. I have no way of knowing it's been refinanced into which loan is it connected to. So I got no way of knowing, whether the refinance was a way of solving a payment issue, or have we extended out the payment terms. I've got no way of linking them. Is there a way to link them in the spreadsheet? They code them or link the numbers together, just some way of doing that for us? I know that gets a little complicated, but I've just got no way to tie them together. So it's like they're just individual loans to me, but I know they're really not.
I can get with Matt and Brad, who pulls these reports from our database. The one thing to keep in mind is that if it says restructured or refinance, that doesn't necessarily mean that it was restructured or refinanced into this program. It could have been refinanced into a different program and no longer has a guarantee on it.
Well, but that's fine. Then they wouldn't be linked to a loan in this spreadsheet. They wouldn't be linked anywhere. So then I would know it's gone off somewhere else, as opposed to being, something going on. So I don't, it's like, I don't know if we've solved a payment issue, potential payment issue by refining, or whether it's just a natural course of business. And I got no way to track it through to know what I'm looking at.
So John, if you look at the loan numbers, the first three numbers of that identifies the client. So if they match, you can see which loans are attached to that same client.
Okay, so I can do that. Well, that's fine. So if I just look at the first three numbers, that links it together for me.
Yes.
Okay. Cool. I got well, I guess my last question. So I'm still really bothered by this loan. If you scroll down this spreadsheet to the one that's like 5 up from the bottom, the one that's basically went delinquent as soon as it was issued. So forgive my ignorance here, but there's a term in England, and I have no idea if it term exists in America. Straight rollers. I don't know if that's same, if we use the same terminology here as we do in England. But a straight roller is essentially someone who takes a loan out and they basically have no intention of paying it. They just take the money. So I presume there's something in the States that guards against the same thing because it's illegal in England. Is that thing still, does that policy exist in America? And again, I'm sorry for my ignorance. I just know it in English terms.
I've never heard it, but we did address this a little last month in terms of immediate default. And Kelly spoke to that in great detail. I don't know if you want to repeat that, Kelly, but it was conditional, not procedural. It was, my understanding was it was a contract not materializing. Is that right, Kelly?
Yes.
Okay.
Well,
If
we
you
are
guys
in-
I don't want to go over a rehash if you guys discussed it at length at the last meeting.
I appreciate your rigor, John. It's very helpful. I think it is continuing to illuminate areas in which we can be more clear. And I appreciate Kelly and Yaslin, you working with us on all this. We're trying to be responsible here, and I know you are as well, and make sure that we're making these reports as accurate as possible.
In summary, for the notes, there were a number of questions that came up. Mountain BizWorks, thanks for researching and answering those that you could in real time. Will you let me know which items you're taking as follow-up?
Oh, as far as the change in the demographics, I think we just addressed that, Rachel. But I'm not sure what other follow-up may be requested.
Okay, so there was the item about the loan that was showing pink.
Yeah, past due and paid, I think, is something that John's point isn't accurately reflected in the data. That was one, and the other was if well, now I lost it here.
Well, let me summarize, hopefully. So as 2 loans, there was 26170104. I felt there was a discrepancy in the way it was characterized. And the second loan was 2639. I've got 0101. I hope that's the right number. 26390101. Again, I had a discrepancy in what I think is the data. So I think the action is there a discrepancy? If there is, can we fix it in the spreadsheet going forward?
Yeah, I'll deal with Matt and we can review it again. But from what I'm looking at right now, it appears correct. Because again, if it's showing zero balance and it's paid out, if it's showing like whatever past due status it is when they pay out, that's what it's going to reflect on there. But if it's a zero balance, it'll show it was past due at the time of payoff and it's a zero balance.
Is that the same answer for both loans?
I think on the other one, I need to pull it up and look at the exact one, but Yaslin, I think that was the one that had flipped on.
But Kelly, shouldn't it say repaid if it's zero balance and it's paid off? So it looks better for us in the data that the loan was satisfied.
We can get with Matt on it. When we met as a group with the codings on here, the terminology that they had discussed and was suggested is release because we're releasing the guarantee with MCCF. If we need to change that and show it as paid in full or paid off, I'm open to whatever is more clear for the group, and I'll certainly take this back to Matt and we'll go over what was discussed in the meeting, and we can, certainly change anything that we can that can make things more transparent. That we're here to work with you as best we can, and any ideas we're certainly open to.
Well, I mean, if it's truly a zero balance that's been paid off, I don't want it to be showing as pink and potential a problem for down the road. It just makes it look like we got another problem when we really don't.
Yeah, it's actually been solved. Yeah.
Yeah.
All right. Thank you. Any other questions regarding the presentation of loans? All right. Thank you both. Continuing with Yaslin, you have some loans for us today.
I do. Give me 1 second. Share that.
And did we see these in advance? Because if we did, I missed them.
Yeah, they were sent out. They were posted.
Oh, they were in Rachel's. Yes. I did see them.
They were posted on Tuesday morning, I believe.
Right. Thank you.
Okay, and we do have Michael Lane here with us as well, and he's here to just really assist in some of the questions that may come up with these loans, since he is the point person on both of these. So we'll say that. So we will look at loan number 1. Let's see. All right, so I will go through and touch on this. So we've got a service type business around educational and marketing, or digital content creators. You can see the NAICS code there. This loan is 50% women owned. It's located in the city of Asheville. This is an existing business. Total loan amount is $75,000. The purpose of the loan is to refinance some credit card debt, which has been incurred as part of the startup expenses of the business, which they were on a 0% interest, which now will be coming due in August. So they are just looking to get ahead of that to refinance before they get hit with the interest rate. So the total outside debt will be $32,923, and then there will be $40,000 of additional working capital to cover the operating expenses that will be that they will have after at closing. All the disbursements will be paid and controlled to the third-party creditors. As far as collateral goes, we have a first position blanket lien, or UCC, on all business assets, which the equipment does include standard office equipment and some media production equipment, which is around $12,500. So there's a pretty big gap in collateral there. We've got this loan for 84 months of P&I, so $1,197. Both borrowers have excellent credit scores. One is a 781, and the other one is they both have the same score, actually, 781. 92% credit available, and the other one has 87% available. As far as jobs go, 2 full-time jobs will be retained with this funding. 1 will be created. 1 part-time will be retained, and then 2 part-time created. Both clients have graduated from our scale-up course, which is pretty intense course and complex course that is essentially a strategy building for businesses to scale up their businesses, in which I'll have also taken 12 hours of coaching in financial analysis and operations as well. So the guarantee amount we're seeking in this case is $63,750. Some other comments about the deal. So both operators have over 2 decades of experience in their fields in education and marketing content generation. In 2023, they utilized their business and personal credit cards to finance upfront costs for large production in their pipeline. So that's how they incurred the the credit card. So again, they were in a promotional period at 0% interest. So now it's expiring in August. So if they are not able to really pay those off, it will be hurting their cash flow as well. They have diversified their portfolio with new client growth as well, and have their 12-month pipeline looks strong and capable of servicing new debt and to also build their savings. So I'll go through and kind of touch on the revenue. So you can see the 2022 revenue was a 64,000. Expenses were 242, and this is really the year that they decided to increase or really expand their services and begin their business. The deficit there was covered by them putting money in there. So the clients invested almost $200,000 into the project of their own funds. So that's how the deficit there was filled. 2023, you can see they had a pretty big jump in revenue. So they went from 64,000 to 204. So their revenue has been improving. They were still in a deficit there. So their net income was negative 57,000. Again, they're still in the growth period as well. In 2024, year to date through June, the revenue has been 116,322. So they're on track to really be able to surpass the revenue in 2023 there. And you can also see they do have a deficit. However, they're slowly increasing their cash flow position there. So Michael, is there anything you'd like to add on this one?
Sure. Yeah, that was great, Yasin. Thank you for breaking that down. I think it's important to notate, this is a growing business, right? And that's really what their historical financials has represented. On a projected lens, the pipeline that's in a net, 30, 60, 90 of projects to be fulfilled is putting them on a 79% track to annual break-even thresholds. Looking at their pro forma monthly fixed costs are about 13.5. Average contribution margin comes out to be a little over 50%, and so it puts them needing to break even annually at 321 in sales. So they're tracking nicely here to reach that, and they're continuing to cast a wide net and haul in more recurring revenue-based clientele. Dee, I see you have your hand raised. Happy to answer any questions.
Yes, I'm just thinking this is a married couple. I'm just going by, you have to pardon my instincts. They're pretty acute sometimes and sometimes not. So I may be mistaken. Looks like this is a married couple. They have good credit. What is their draw? Are they a C Corp? Are they a LLC? Or are they just a regular old business tax return for individuals? What are they?
Partnership, 1065 tax filing.
1065. Okay, so what's the draw? What are their salaries? What is the largest expense? Is it their personal draws or the partnership share of what is the biggest expense? Interest seems pretty minimal, like $1,000 a month.
Right.
So I'm looking at, is that partnership draw? What do they draw on that tax return? What is their partner's draw on that?
For sure. So they're not a married couple, long-term relationship, living together.
Well, same thing. Yeah, go ahead.
Yeah,
No problem.
right. Their draws are quite minimal because, again, this is growing, right? So their draws would be based off of, quarterly or monthly or annual profits. They need to be able to take home, household wise, about 100,000 to just cover everything and also have savings for themselves, right? Long-term financial planning on their end.
So where do they draw income from now? Where do they, is one of them working on a job? Because I'm trying to just in my mind get straight as far as cash flow is concerned here.
Sure. Yeah. So a lot of their income is based on project-based services. They become the contractor in some of these projects going forward. again, part of that seed capital that they put in from themselves was also to cover operational costs inclusive of their own payroll over time, right? So money goes in, money goes back out to them. It is able to be contributed, but in a much more limited scheme because it's obviously going towards their living costs. It fluctuates. There's no set because again, they're just drawing off of profits. They're not S corp structured, so there's no fixed officer salary to them. It's just what they can at times, or on project basis for 1099 to themselves out of a service contract.
Okay, I was just thinking they have pretty decent credit scores, which leads me to believe that they've been making, keeping up with their payments and so forth. I was just wondering where it was coming from based on the numbers that we see here, where they've taken a loss almost every single time. And it doesn't seem like they've got that much credit card debt. I mean, $1,000 a month is, it's kind of average for most folk. Kinda. I guess I'm just looking at whether they intend to get these contracts from. Is it from government? Is it what are these pro formas based on? These are pro formas, right?
Yeah, so they're historical and projected here, right? So they've got contracts with a number of high profile nonprofit institutions here in the Asheville area.
Okay.
They've also got contracts in the private sector and also in the public sector with the city of Asheville.
I thought so.
I don't know if any of us have to recuse ourselves because I don't know if it's any specific departments, but triple threat when it comes to sourcing here of contracts, both nonprofit, for-profit, and government sector.
Is there any way to put a contract out that would assure us of payment on these accounts receivables once they got them? Because I used to pledge my government contracts all the time if I needed to.
I think it's something.
Or is that something?
I think it's something worth looking into, Dee. It's a great point to really secure repayment here.
Yes.
The promissory note, obviously, they're going to be guarantors on this themselves. So there are elements that, on paper there should ensure the repayment of this. There's also then the soft structure of it to, again, they both have really great credit, right? And one of them has 92% credit available and the other one has 87%. So they're not heavy credit users, right?
No.
And the credit they do use, they pay off routinely. So there is kind of that, subjective qualifier there of they're incentivized to pay this, right? Because it's going to be reporting. And so they don't want to impact their credit. They don't own a home yet. And that is a personal financial goal of theirs. So getting this business to where it is moving, but, ensuring that it's going to land where it's projected to land is obviously high priority to them and for us.
Okay. And in closing, let me just say that I'm of another ilk. I believe in it. If anybody has any assets, the next question I was going to ask you if they owned a home, if we could put a lien on it. I'm not into financing people who can go get finance somewhere else. This is kind of like a loan pool of last resort. And so I would ask, my whole thinking is that I would need, and I'll vote for it if y'all vote for it, but in the future, if they've got contracts that they've already executed, especially with the full faith and credit of taxpayers behind them, I want a lien, put a co-payment agreement put on that contract that we also collect at the time and are a co-payee on that. So that's all, and I'll cease with that. Thanks.
Sure thing. No, thanks, Dee. I think it is worth looking into. We just want to make sure that we're not going to impact their ability to cover any other OPEX as necessary while still prioritizing our debt service, of course. Yeah. Great point. Thank you, Dee.
Michael, in their projected pro forma, what is the break-even period? When do they expect to go positive?
Yeah, here, let me get the monthly pulled up on my end. Give me 1 second, folks. So on a month-over-month cash flow, give me a second. Let me format that. With some of these contracts coming in, where we're seeing the business really turn the corner and begin to retain some profits is end of Q1 next year.
And revenue and loss for the end of this year of 24?
Yep. Let me reference that real quick. Mhm.
Go down farther, Yaslin, would you?
Let's just get the spreads. If we take annualized snapshot here going from June to June 24 to 25 here, expecting to close 308,000 in sales with controlled expenses there to leverage towards a break-even point. When you do a full pro forma of 13.5 and change, which that's not their current monthly OpEx, right? So notating that it is a reduced OpEx up until a certain run rate. But once you do annualize that, future break-evens need to fall at about 321,000 in net sales
Annually.
Mm-hmm.
And what are they expected to do this year?
So again, if we run like 12 months starting
not
from
12
here
months,
forward,
but just to the end of the year.
I can run some spreads real quick for you.
I guess
but at the end of
they're
the
at
year,
116. Are they going to be at 230?
they're going to be pushing. They're on track to break 220 in sales at the end of this year. Yeah, obviously receivables are flexible, but yeah, they're on track to break 220.
And net cash positive at the end of the first quarter of 25.
Mm-hmm.
Okay, cool.
And just
Any
a
other questions?
quick note, Michael, the sheet that you're displaying, or maybe Yaslin is displaying, is different than the one that's in our packet. It has more information. So if you would send this updated form to city staff so they can add the new information, which is the 2024 data.
I will send it over.
Sure.
All right, thank you, Michael. Any other comment on this loan? And if not, do we have a motion? Dee?
Thank you, Mr. Vice Chairman. I move that we approve this loan to this 1065 business.
Thank you, Dee. Do we have a second?
I'll second.
We have a second. All in favor, please raise your hand or click in the affirmative. Touch that, Rachel.
That looks like everyone.
All right, great. Thank you very much. All right, Yaslin, the next one.
Right, so we will move on to data collection for number 2. So we've got a retail type business. You can see the NICS code there, 51% women owned, located in the city of Asheville. This is also an existing business, started in 2018. The amount requested is $75,000. The purpose is the funds will be used to outfit their new location as they will be moving into a brick and mortar, and will also be to replenish working capital reserves. The outfit itself is going to cost them $56,700. The remaining will be used as working capital. All disbursements will be controlled and made payable to the third-party vendors in this case as well. As far as collateral goes, we have a lien on all business assets, which includes equipment, inventory, and then some credit card processors, computers, total value of $10,000 there. We will have a second deed of trust on the borrower's residence. About $100,000 of equity is available in the home. We've got the amortization is 84 months of P&I, so $1,197. The credit, one borrower, there's 2 borrowers in this case. The borrower has a credit score of 713 and the other one is 587. There were some charge off and revolving accounts and some late payments as well. Those bad debts have been settled. Also this borrower specific has had a successful history with Mountain Bisworks, have been in our network for quite a while, and also fully repaid their startup loan, which is $50,000 as well. That was not within NCCF prior to this. The jobs. There was two full-time jobs retained and 2 part-time created with this funding. They have received over 10 hours of technical assistance in operations and financial management. The total guarantee in this case would be $63,750. Just a little bit of background there with on the business. So the operators have shown tremendous resiliency in all chapters of the business. Most recently in 2023, they had to essentially vacate the brick and mortar location they were operating out of due to their landlord's intentions. So their intention was to sell the building and that they occupied. So they essentially had to get out, which was the last 6 months of 2023. And then they pivoted to 100% online, to an online platform. And they've successfully been able to close $220,000 in sales, which is an 18% increase versus their 2022. The business owners are well ingrained in the local business community. They're poised to launch their new store. So in August of 2024, which is that's what the funds are going towards. So we'll move to one thing to know is the revenue in 2024 does not represent a brick and mortar location. That's solely just online. So I'll start with the 2022 revenue. So in 2022, they did 188,000. Expenses were 84. They had a net income of 6,600. Their interest, they had a small amount, $2,000. So came out, their EBITDA was 8,690. So they've been able to really maintain a positive cash flow over the last 3 years or 2.5. 2023, you can see they had a pretty good jump there from 2020 to 223,000. The expenses were 102, and they ended up netting 22,742. 2024 through June. Oh, I'm sorry, 2024, I believe through June. Revenue has been 39,000. This is solely online revenue, so you can see there's a gap in the revenue due to them not having that brick and mortar location. Their net income still, they've been able to maintain positive cash flow, 4,231 as of 2024. So with that, I will open it up for questions.
I have a question. I don't understand the statement in the narrative above the historicals where it says they had an 18% increase in 2022 numbers. Increase. This was in 23. This was all online.
Yeah, here. So let me kind of give some color on this one because there's moving parts on this one, Carl. So year over year, so this business opened up in 2018 with a startup loan from Mountain BizWorks, and year over year they continuously grew their retail sales. No online component had really come to the forefront until COVID, and that 18% revenue increases from 2022 to 2023. We can unpack a lot of the 2023 revenues there, but effectively, like growth is great. The retail, brick and mortar is stable, or was when they had it, and unfortunately, they were forced to vacate. No fault of their own. Renewal term came up. A landlord decided to sell. So they had no lease that would secure their tenancy in that spot going forward. They literally been just operating their online component in their basement since mid 2023 last year. A new spot has just been taken over further up the road. So, as far as location wise, it's about 4 blocks further, 4 to 5 blocks due west from their old location. Anecdotally, this new location is much more foot traffic friendly, right? Their previous location was quite sleepy. They had moved into that thinking that it was a new development that had popped up with some mixed retail that they wanted to go into. Unfortunately, it turned into a very slow foot traffic space. This location is starting to see a nice resurgence here in the Asheville area. Lots of new development surrounding it, and by development I mean businesses moving into some existing leaseholds here with popular brands behind them. The most important aspect of this one is on the personal guarantor profile, because throughout this, so it's a partnership, right? 51% woman owned, their spouse is the other 49%. And historically, up until last year, the business had to support both of them, right? Key change here in that the 49% owner has, still has equity in the company. However, has built a career for themselves outside, where they're now bringing in six-figure income, stabilizing their household together, and when running a global debt service coverage ratio, has the capacity to service their own personal debt and also this business debt wholly, right? Cool. With like not even considering any kind of revenue from the business to support it, right? So really strong improvement from the household here in the personal debt service capacity side. One of the questions that I had brought up during underwriting was, okay, we did a 50 to start. I love that 50 microloan size. It's such a great tool for businesses, kind of relaunching in this case, or just starting. And so I asked, what kind of capacity do we have, again, with such high new levels of personal income coming into the household? What can we apply towards this to offset it? Maybe take that 75 back down to 50 and not have to finance so much over time. Their answer was a mixture of things. One, they've already been contributing towards this project out of pocket already to the tune of $22,000 plus. Two, those debts, those bad debts on the wife's profile, they applied a bunch of their own cash to it. They even did a refinance of the house that we are getting a second lien on that one. So we're going to have some we're going to have some tangible security on this, right? They did a refinance out of that and verified the payoff of those bad debts through a settlement sheet through, attorney's escrow disbursements, right? And then furthermore, they're a couple together. They had a life before they met. There was a child in the mix from a previous marriage from one of the partners that has now settled a custody matter, and that is not cheap. So a $35,000 personal out-of-pocket expense there was no more cash to really apply towards this, right? So 75 it was, leasehold improvements, give them some meaningful working capital, and help them get this brand back into a brick and mortar retail in the same community that it used to serve, in a stronger foot traffic location now.
Cool. Dee, go ahead.
Thank you, Carl. I just wanted to say thank you for putting a lien on that residence. That has restored some of my faith. This is a retail business, and I'm kind of negative on retail businesses unless your last name is Walton. But at any rate, it seems as let me ask you this: what's their credit score? I forgot to ask that.
One of them is what was it, 713? Is that right? Yeah, 713.
713. Yep.
And then of course with those bad debts on the other profile, right? 587.
Okay, so that's not really insurmountable. I guess the thing that bothers me, and I know you've got a lien on the personal residence, and these folks have six figures coming into the house of independent income. Why is the term so long?
We settled on that term. One, putting a $75,000 loan, principal balance on 5 years is a meaningful payment, right? And so looking at the fact that this is a relaunch, there is going to be a bit of that curve for them to get the revenue back up to where it needed to be. We felt it prudent to stretch the term out to make that term a little more, or that monthly payment a little more palatable, right?
How much is that? How much is that payment?
Just under $1,200, $1,197.
That's cheap. Yeah, that's pretty cheap. I guess it's fine. I just don't like a lot of these loans. They get a 3-month moratorium, and then they get these very long terms. If they've got 6 figures coming into the house, for somebody like me, I would want a shorter term or I just would. I mean, but
Yeah.
I'll vote for it if everybody else votes for it, only because you've got to lean on the personal residence.
Okay.
All right,
Yeah.
thanks.
I think that's strong cash flow, so that's good.
Yeah.
All right. Any other discussions?
Can I just ask I mean, it's not going to change my opinion about approving this, but whenever I was negotiating leases and upfitting buildings, the landlord roll in the expense into the terms. So why is this couple accepting an outflow of $56,000 when they could negotiate the landlord to do that? And if they won't, walk away and find a different one. It just seems like a massive expense that they don't have to bear.
Yeah. The overall renovation is a massive expense. So this building, like, foundation was falling apart, right? It's an old historic bungalow. The landlord has assumed, I didn't do a percentage breakdown of tenant improvements versus landlord improvements, but I want to say after purchasing, she's put about $120,000 into the renovation of the space so far. The rest of this is all just it's millwork for fixtures and furniture. It's a little bit of wall improvement there, and then they did some electrical upfitting.
Non-leasehold stuff.
Yeah. That sounds like a lot of money to spend to get it going. So, but
I'll be honest, John, from a lot of the projects that we see these days, I mean, it's pretty crazy. I'm questioning if I'm in the wrong field and maybe I should be an electrician instead. Budgets are wide when it comes to renovations these days. And from previous experience, we really wanted to make sure that we had clear terms, and we do have clear terms as far as who's responsible for what on that lease agreement. Because we really didn't want to get involved in construction. We wanted to do renovation, right? Actual leasehold improvements as opposed to structural upgrades that the landlord has assumed.
Sure.
All right. Any other questions? Do we have a motion?
I move for approval.
Thank you, Frank. We have a second.
I'll second.
Second from John. All in favor? All right. Thank you. Again, this ever improving clarity of the deal is very, very helpful. So thank you for doing that. All right. Is there any unfinished business that we have not covered? Any other comments? Oh, we have a hand there. Rachel, go ahead.
Yeah, I'd like to chime in. Thank you. This is not an item that's on the agenda, but staff are talking about bringing to this committee's agenda sooner rather than later a conversation about the custodian. As you'll recall, Self-Help submitted a letter asking to have the custodian, the holder of the fund, be reassigned. And our current thinking is to put out a competitive process where we invite other institutions that might have that capacity to submit proposals, and then give this committee the opportunity to discuss and award that would align to the changes that are underway to the operating or the governing documents. My recollection of those that draft is that it gives this operating committee the flexibility to reassign the fund holder. So know that is happening and will be coming this committee's way soon. I think it's January that the current agreement with Self-Help runs out. So that gives us the fall to complete this work.
Great. Thank you, Rachel. Any other old business or comment? And Charlie, do we have any public facing comments?
It does not appear we do, no.
Okay. Anything I've forgotten? If not, we will call our meeting adjourned at 10:30. Thank you all for participating. Good progress today. I appreciate it. Have a good weekend.
Great job, Carl.
Thank you.
Thank
Bye.
you. Bye.
Okay.